Yeah.
Today, I'm joined by Tim Danser, founder of Finity. Tim's background spans investment banking, venture-backed startups, and senior leadership roles at Google Cloud and Mandiant. Now, through Finity, he helps VC-backed founders bring real financial clarity to chaotic growth. But what makes Tim different isn't that he's just a fractional CFO. It's that he's building something closer to a fractional COO layer, helping companies move from messy to investor ready without blowing up along the way. Today, I want to unpack what founders get wrong about finance, where growth actually stalls, and how Tim is scaling Finity itself. Tim, welcome to the show.
Yeah, thanks for having me. I'm excited.
So am I. Thanks for coming on. Here's where I'd like to go. Let's kind of talk about your path into building Finity and then the real problems founders hit as they're raising money. And then we'll zoom into growth, both for your clients and Finity itself. So, you've told me you've been inside Google Cloud, Mandiant, venture-backed startups. What did you keep seeing that made you say founders need something different?
Yeah, it's been an interesting journey. I I suppose I started my career at bigger companies, something like I did commercial banking, investment banking, strategic corporate initiatives, and then Google, Ambient, and all that. And what I where I landed in my journey was I took one quick stint at a startup and we got bought. And so it was just a super fun journey. Like what I loved was at startup world or startup land, it's most about just solving big ambiguous problems, big challenges. And then what I've loved and some of the biggest challenges that we see day in and day out is how do you balance between the resources you have today and where you want to go. And those inflection points between the two constantly need to be weighed. And so those are the things I love working on and what I engage a lot with founders on.
Now, we kind of use that word fractional CFO loosely. That can mean a whole lot of things, from bookkeepers, strategists, anything in between. What does Finity actually do that's different from a typical fractional CFO shop?
Yeah, it's a great question because when I think of fractional CFOs and a lot of people think of fractional or outsourced or however you want to think of it, there's kind of a spectrum of services you can engage in. And there's a marketplace for every one of those. So for example, there's people who do bookkeeping, and bookkeeping's important. And saying that, here's the volume of transactions that Amazon needs to go to office supplies and DoorDash needs to go to meals. Well, those things have to get done. It's part of the blocking and tackling of all accounting functions. As you start going up that spectrum of services, you get into a little bit more um, of the more technical accounting and more operational tactical items that need to get done. So a great example is treasury management. So a lot of folks I engage with, the founders will say, hey, I need to manually move $1 million from this bank account over to this bank account so that I can run my operations and I can get more yield off of my savings. And just having little tips and tricks, like knowing that there are sweep accounts that can move the money automatically for you. So that's as you start going up in that spectrum of services to say, there's people who have the little tactics and things on how to make your operation smoother. And then there's what I see that Finity does. And, we're more of a highly tailored kind of approach. So how I describe it is we have 6 core pillars that we really try and differentiate ourselves against. And those are breadth in certain disciplines that each company kind of needs: accounting, finance, ops, and then having the ability to cross-link those disciplines across each other is really important. And being results-oriented and tailored to each client's needs, that's what I find a big differentiator with us. A lot of times it's not necessarily just saying like, these are the expenses and these are the revenues and these are the accounting. But it's being able to execute against our board meeting is this date, and we are a high velocity business. So we need a tailored approach to how, subscription sales that are coming in daily and all that gets done. And then finally, one of the big things that I
Right.
am really trying to reinforce with our team is being tech forward. Finance and accounting tends to be more backward leaning and a laggard function with everyone. So Excel and spreadsheets and all of that. And what we really try and let folks know is that that's not how things should be. Now, do we use those things? Of course, they're a great tool in your toolkit, but there are so many other better dashboards and automations and things you can leverage that are outside of the traditional role that finance and accounting takes.
Yeah. Thanks for explaining where Finity falls on that spectrum. I'm interested in the moment that made you say, "I'm not just gonna consult, I'm gonna build a firm." Like, what was that like?
I think like all startups, part of it is just a very bumpy journey. You talk about the pivots, twists, and turns. Never once did I say, you know what, I'm going to meaningfully start this firm. I guess where I went with it all was I said, let me kind of I like doing this. I love working with startups and I love working with people who just simply know that they need help. And why I love that is it's easy to show your benefit to them. It's easy to say, let me build you a model. Let me work on your books. Let me help you save a ton of money on your payroll without changing anything other than the payroll provider. Those are the things I love doing. So I gravitated towards what I wanted to do. Now, that so happened to be um, in my own consulting firm. Not a lot of people would just let you kind of like do what you want to do. There's handcuffs and hamstrings wherever you usually go. And so what I found is to be the most flexible and tailored to different companies is doing my own company. And to be honest,
Mhm.
I wasn't even going to do it. Like there were two key people in my life at this pivotal moment. And one of them was a family friend of mine who said, Tim, you're not going to have an opportunity like this again. You might as well take the plunge. And then God bless my wife, who has been just wings behind me and has helped kind of like push me into this. In finance and accounting, there's not a lot of folks that are super adventurous and risk takers. And she was the one that really kind of said, you got to try. You got to at least try. So God bless her. That's how we ended up here.
Yeah, I love that. Love that. Let's talk about some bottlenecks, uh, specifically about pressure after capital. You tend to work with pre-seed through Series B, C companies.
Yeah, yeah, yeah.
Is that a
About that.
good,
No.
like, kinda what you do? Representation? Okay. So what changes the moment institutional money comes in to a company?
I think a lot of founders, especially in the seed and pre-seed stage, tend to say, I just want to build a company and I just want to build this product. I know there will be a market for it. And so there's a lot of things that kind of come out of that. As you get to institutional fundraising and new money's introduced, it's usually around seed to mainly A and a lot of B stage companies. There's a certain kind of two-pronged problem that happens. One is a lot of founders don't necessarily want to sell in market, and it's tough selling. I think a lot of salespeople out there will say it's not the easiest thing to do. And so knowing the right people and who to go in and get and how to market and how to think through all those things, that's one big pillar that a lot of people address. I need a new CRO. I need a new head of marketing, so on and so on. But then there's the second kind of thing that really presents itself, which is, okay, now I've got money. I have a priced round. I've got one new investor and two or three existing ones. They all want their quarterly reporting packets. They all want a budget. They want a forecast. They want board reports. They want reporting. They want 409As, and I got to do the tax returns, and I got to do this compliance filing. Now I'm going to hire a bunch of people. How do I go and hire them so that I don't break the bank? And what does scaling really look like? that's where we help. So a lot of times people ask me, when's the best inflection point to engage someone like yourself? It's when you're spending nights and weekends working through accounting entries, payroll, reimbursements, 409As, tax returns, all the garbage that has to get done within a business. That is our sweet spot.
Mm. I could see all the founders out there flailing their arms, drowning in an ocean of tears.
Well, I'll tell you, I mean,
Yeah, but thinking
there's
about
just
that, they're
there's a
like, "I
lot.
just wanna sell my product."
And you know what's funny too is one of my colleagues when they joined the team, she had a family friend of hers going, "Hey, I want to start my own business." And after she had been with me for 6 months at Finity, she goes, "I don't think you quite realize all the things you are going to have to do. You first need to go to the Secretary of State and then the Department of Unemployment to register." You know, those little things, like just little things that add up into big, big problems. Yeah.
Yeah. Yeah, those are mounting problems, certainly. Um, for you, what would you say is the most common, "Oh, no" moment for founders, um, that hits after raising capital? What would you say?
I'd say the one I frequently get asked right after someone's just raised, they go, "I've just raised money." And a lot of founders do this, and not bad, by the way. It's just a pattern that happens is I've raised money, I've hired a bunch of people. I have no idea if I have 6 months of cash or if I have 24 months of cash. At the stages I deal with,
Oh,
cash is king, and a lot of people manage have to get in this cash management mode. You look at these large enterprises, and luckily for someone like myself and my team that have a spectrum of, we've worked at Google and Blair and all these other big companies down to, companies that are on the brink, and being able to say that here's how you manage cash well, and here's how you can think through your hiring plan, and here's how you can extend, and here's what you need to do if you want to burn, and let's work through all these assumptions, and how do you get all the little pieces to work together? So that's usually the point where a lot of folks after raising money is they want to go out and hire, and they can go higher, and they want to go higher. And that's usually the biggest like catalyst for talking to someone like ourselves. There's usually a million other little tiny items, but that's the big.
so if I was just to, like, reframe that, it's really what you see in terms of the biggest kind of questions that come up, like, "I don't know where we're at," is really, like, how much runway do we have
Yeah,
once they get money?
that would really be it, is
Wow.
do we have 6 or
Yeah,
18 months, and especially like we've
okay,
had folks
yeah.
engage us saying, I want to spend money on a Super Bowl ad. And how much is that going to cost me? And just helping people be able to quantify so you
And
can
you're like,
figure out.
"Whoa, whoa, whoa."
I mean, will say, hey, I am not the person to talk to about how to go to market. Like I can help you frame up and quantify whether a Super Bowl ad makes sense or not. I'm here to measure for you, not tell you whether that's the right idea.
Yeah, okay. Um, Let me get your take on just growth breakpoints for these companies. For you, what would be common first financial signals that tells you a company is about to stall? You have any take on that?
Oof, I got lots of takes on it. So I don't know,
Awesome.
Chris. Like, I don't want to spend too much time on the topic, but I definitely have a lot of seasoned experience in it. What I don't know if you
Yeah.
remember COVID, but I had to manage through that, and I'm happy to talk through that experience if you want.
Okay. Yeah,
Um,
please.
so when January 2020 hit, everyone's pipeline froze in the sales front, and then February and March started coming through, and it really kind of started to freeze and stall. We sat down then they started shutting down the states. They said, everyone's got to go home. So what happened is pipe just froze across the board. And the board came to us and said, you have 6 months of cash. You got to turn it into 18. And so that's kind of the bread and butter inflection point of saying, here is where we see our existing business today, measuring out the number of existing cash inflows you can expect and what you expect payroll, um, all your program spend, all of that. Why that's important is understanding the historical trends it helps evaluate what levers you can pull on in the future. So knowing you have a 12-month contract is a lot different than a month-to-month contract. And being able to rank, stack, and prioritize where to pull the levers on individually. Obviously, the biggest one in software is usually always people and cloud spend. And so knowing that, being able to say, when do I need to make decisions? How do I make decisions? What's the way to do it? That's where we've helped a lot of folks with that one. And it's a key decision point is being able to say, again, like, what are my inflows, outflows? How can I measure against that? And how can I find certain breakpoints where I need to make decisions?
Thanks for your take on that. And
We, al- we in finance always think of the worst case scenario. And it's
okay,
usually it's the downer conversation. How do we protect ourselves from this? How do you protect yourselves from that? What I think a great strategic finance partner does is not only plan for the downside, but how do you find the break point for the upside? Like, what does that kind of look like? And what I mean by that is, as your business is starting to accelerate, how does someone in finance and ops help you manage around that? And what I tell folks is, you need to do more than just say, I have a revenue plan. And when I say revenue, that's not necessarily GAAP revenue. That's annual recurring revenue or deals targets or bookings targets or all these other things. It's nice to be it's nice to have a plan at the beginning of the year. And as you start to beat plan, that's great. And that's helpful. Those signals are helpful. What I find most helpful though is that someone who can help analyze that here is our marketing events, here's our campaigns, here's our sources, and being able to use finance disciplines against ops work to know how your pipeline flows through the funnel, how long it takes to go through that funnel, the conversion rates between each stage. That's a great finance partner, in my opinion, and someone who can really help you manage the downside and find signals and areas of growth for the upside.
there you go. Yeah, thanks for that insight. Tim, if I'm an investor, or excuse me, if I'm a founder listening right now, how do I know if my financials are helping me grow versus just checking a box?
I would say your financials as a founder should be used to help you manage, spend, manage your cash, manage the risk. And that's the first step, I would say. So what I mean by that is, how much cash do you have today? A lot of founders can't answer that. And the reason they can't answer it is because the books are 3 to 4 months late and they're really sloppy. And then the second is, do you know where your money is going to and what money is coming in and how much is coming in? The number of times I've opened up a founder's QuickBooks and there are agings that are 3, 4, 5, 6 months late. I mean, I can't tell you the number of times. And the reason because of that is not because they're not great at working with their customers and collecting, but it is yet another thing to do where you just have to work your AR and get those customers. They have this portal and they have that thing, and everyone's got their unique thing on how they want you to get paid. So that's step one, in my opinion, of how your finances can help manage it. But then your finance professional, accounting ops professional should be there also giving you signals on where's the best ROI on your dollars spent. Like, is it marketing events? And while they're more expensive than everything else, you tend to get the best leads. Or is it Google Ads? Or is it podcasts? Is it webinars? Is it all these different things? That's where a great finance professional can step on it.
I like it. I'd like to move on to a little bit more about what it looks like to work with a firm like yours. Can you tell me what like a first month typically looks like with you?
what I always like to start with is we're going to take out the trash better than anyone else. We will do those garbage tasks that you don't want to do better than anyone else out there. And that can be just tiny little things, just little compliance audits, reporting checklists. What we usually like to do is start with a financial model to help you get we talked about when you go fundraising, a lot of folks don't know how much cash that is. That is super easy for us. So for us, usually where we like to earn the trust is saying, these are the inputs we need to build you a cash forecast. And this is what we're predicting. And those first few months are an iterative process. It's not like you're going to get it right on the first time. It takes time to refine what you think is appropriate and what your plan is going to be, both on sales as well as headcount to marry up the sales and all those little interdependencies that come together.
Yeah. No, thanks for explaining that. Would you kind of run me through like how long your typical engagement lasts? Is this a long-term thing? Is it relatively short-term? Like what is kind of the end game with that?
So we like to be super upfront with folks, and it's really kind of what they want to make with it. I will say usually our engagements last 2 to 3 years, if not longer. We've had some relationships where it's 3 to 6 months, but a lot of times too, it ends up being we need help building a plan. We need help with this. Oh, we need help with that. Now it's this. And as those things scale, we are at a much lower price than a full-time headcount. And the difference too is when you have a team of professionals in banking and accounting and ops and finance, what that allows you to do is scale and it gives you the needs you need today rather than saying, I need an accountant who's full-time. I need an ops, a paralegal full-time. That's one of the advantages of going with a fractional service firm.
Certainly that you get a team of experts to help you instead of in-housing, like you said, a full-time accountant in your company and making that new hire.
Exactly, because a lot of the times, within the startup world, you don't have unlimited resources. And so you don't need a full-time accountant. And so you're thinking to yourself, let me have them do my collections. Let me have them pay my bills. Oh, now that they're doing all those things, let me have them stand up my CRM. But not a lot of times, a finance and accountants know ops and reporting and pipeline and tech stack and deployments. They'll go hire a consultant to do those. And so that's where it's tough when a founder will hire someone thinking they're a jack of all trades and they could do lots of things. But really, they have a specialty in what they do. And now they're end up spending even more money on fractional people with their full time.
I like that. Let's talk a little bit about Finity's own growth now. Um, you've described it as in being in hyperscale mode when we last spoke. What can you kind of describe what's driving demand right now? What that looks like for you?
Startups don't have one need in accounting or financial modeling and financial planning and analysis or um, help with contract reviews, running payroll, issuing options. They have all of those needs. And that's really where we kind of thrive is not a lot of people will address all of those needs. And that's something we can do at Finity is help you build out forecasted cap tables, help manage your audit requests and 409As and prepare financial statements, all the things that go into running a business. That's what we can do, which really separates us.
Okay. Can you talk to me about ideal timing? Like you said from pre-seed all the way to uh like round B and C, right? Like what's ideal for you? Is it before institutional money hits and you're getting them ready for that and then seeing them through that whole thing? Or is that a difficult sell because you're asking for a 2, 3 year engagement and they're like, we don't even know if we're going to be around like in 6 months?
I mean, I'll be honest, Chris, like this nice painting behind me and this chair and this setup, it wasn't done by me. This was done by a professional interior designer, and God bless her because she did a great job. Now, she did a much better job than I would have done. And it's same with your books and your finance and all of that. When you're a founder, it's best to have someone who knows this stuff in and out. because it'll be much easier and cheaper to have them do it than to go back and clean it up. What I also caution a lot of founders on is you need to balance your resources. A lot of times you may be okay with not best in class, and that's okay because someone else will clean it up later for you. And so you just have to decide, is the extra money to set it up right more worth it? And do I have the capital to do that than to clean the mess? Because after you get a big Series A or a big Series B, hiring someone then may make a lot more sense. You're just going to pay more for it to clean it all up.
Got it.
So, in
Okay.
my opinion, there's no
Um,
real bad time. There's not a bad time to do it. It's just, is it the right time for you based on your needs across your business?
sure. Would you say your referrals that come to you or the way you get in front of your clients, is it mostly through you reaching out to founders, them reaching out to you, or are you actually going through like VC and PE funds to the potential portfolio companies? How do you
Yeah,
find
we
people?
we kind of explore all channels. So what I would say we've really done is it's VC and private equity are kind of the main places we generate leads from. So we partner a lot with VCs, and that's a lot because they know we'll do a good job, you know. Now in the VC community, it's easier to talk to a breadth of folks. That doesn't mean it's going to translate into a closed deal. It just means we'll have a conversation. I usually always give free advice to folks, not because I'm like, I mean, part of it is the pitch, but on the other hand, what I really pride ourselves in is we're going to deliver you value. Me telling you how to do certain tax strategies is not where we're going to provide a ton of value. I can easily give you a 30-minute call to talk about cloud cost optimization or tax strategies, and that's going to go, you'll be able to do a lot of that on your own. Now, if you want help on the execution, that's where we really kind of provide value, is pairing up the strategy and the execution on.
On that note, Tim, I know you probably wouldn't tout this much yourself, but obviously you've been to a very reputable school, Wharton, right? But some of these PEs, a lot of the VCs and PE guys also have that kind of background. Do you find that some of them are like, hey, we already have what you're doing kind of internally where we help our portfolio companies out like that? Or are they very much like, hey, big picture, yeah, we're there, but you can go out and go help these companies implement? What do you see?
For sure, for sure. So some like bigger institutional private equity firms and VCs, they'll have those. And your experience, I'm curious about your own experiences. Not the way mine has been is usually the VCs have less of that, private equities have more.
Yeah.
Um, and
Yeah.
what I will say that I've seen is a lot of private equity and VCs, and rightfully so, the business model is meant to go out and get deals. So their sole focus is getting deals. They'll make intros. Some will even help with a few strategic items. One of the big differences that we really see is, for example, a private equity firm sometimes, well, a lot of the times I've run into it, they don't want to do a cash to an accrual conversion for their new portco. It's brutal,
Okay.
absolutely
Fair.
brutal doing that
Yeah.
conversion. And so that's where we'll get engaged with stuff is, we talk about
I see.
you can build up a lot of corporate debt over time. When you go to raise money, it's okay to say my cap table's a mess, I have no plan, so on and so forth. But post money raise, the expectation is you're going to go do those things regardless of it. We talk
Okay.
about if you get $15 million and you hire 20 people, well, one of that 20 better be someone who's going to clean up these things. And if it's not that, then a resource that is. That's the expectation. And that's usually why we
Got
work
it.
with those types of folks, is there's a lot of things that
Okay.
private equity and VC can add a lot of value, but where they engage someone like ourselves is a lot of pairing up either their strategy or our strategy with the operations.
I got it. Yeah, I've seen quite a few times where you might have a private equity firm that focuses on like leverage buyouts, for example, and they would, you know, say, hey, we've got a guy who has a consulting background, we got an iBanker, we put him in the company, we got a 5 year, stretch what we're looking to flip this in. So for the first like 2, 3 years, those guys are gonna really be hands on in that business and be doing most of the stuff to do it. Other ones are not quite like that, but I have seen kind of a mix like that as well.
And it's interesting that you bring it up, right? Because you talk about bankers and those folks are great at doing deals and great at building models. I think if you pull in the right banker, you could really get someone who can help you with your FP&A front. Like there's a lot of value of someone that can do that. Now, the other hard part of that is you'll see in some of these models, there's like just like in accounting, banking has the same as there's folks that will say, here's the expense to revenue ratio that we should hit, because that's what the market dictates. Well, there's a big difference between an expense to revenue ratio and a hiring plan. And knowing here's the zero-based budgeting approach with we need to go to this marketing conference and we need to spend this much on demand gen and we need to spend this much on lead lists. And knowing those, that's where a real plan can kind of help. And someone who, sometimes not always is at, in the firm, but someone like ourselves, or it sounds like folks you've run into where they can provide expertise.
Yeah. No, interesting take. So if I was to kind of re-summarize that, you say a lot of your leads come through VC and PE. Is it kind of like you're meeting with them and you're saying, hey, I can basically be the quarterback for the kind of stuff I do with your portfolio companies, and then you kind of get carte blanche to go and talk to each of those founding teams? Is that kind of
What I would say is my
a
typical
normal
motion.
approach, would you say?
What I would say usually happens is a lot of VC, like I'll engage a lot of VCs and private equity folks. Just I'm not a big fan on the hard sell. What I like to do is explain the value we can bring, and if there's something there, then there's something there. But if it's not, I'm happy to part ways. And I've had conversations with founders where it's been a 15-minute call, and I've said, your firm that you got, they're doing a lot of what I would do. I wouldn't recommend shifting over to us because that's a lot of disruption to switch finance and accounting firms and ops firms. If they're doing a good enough job, this is not your pain point. There's use what you got. A lot of times the way it is a VC or private equity will say, you really need to talk to this firm, Tim, because they got a lot of problems. They have this scaling problem. They have no plan. They need this. But it's a delicate dance, and a lot of times we meet great founders that are doing a great job. It's just they don't want to do this anymore. They it's painful sometimes to have to take out the trash. I just did it a couple of minutes ago, and I didn't wanna do it, and a lot of founders feel the same way about these kind of roles and responsibilities in the back.
Yeah. No, that's fascinating. When you were relaying what that conversation looks like, I was thinking of that Jerry Maguire scene where he's like, "Help me, help you, help me, help you."
Yes, yeah, yeah.
That's awesome.
Well, I like to say this is how we can help you. It is your decision whether you I guess it's the same thing.
Yeah, yeah, interesting. Yeah, I'm always fascinated how different service providers work together with VCs and PEs specifically because they're kind of their own little micro communities of how they work and how they want to work with their portfolio companies, how involved they are, how much they want to grow the enterprise value, and they're looking at these timetables and obviously talking to their investors too. Um, with that, there's kind of the emergence of family offices too that I think are moving a lot more towards what like private equity would look like, except very concentrated plays. Have you talked to any of those types?
Work with smaller shops, not necessarily family shops,
Okay.
but maybe 1 to 2 partners at the PE shop, um, where it is super concentrated. And that's honestly like, Chris, I'd love to hear your sense as well too, if your experience has been the same. But what I've seen is like they definitely know we just want to close deals. We don't want we hire these people to do the job. We're not here trying to go and run companies. We want to go and buy the companies so then we can flip them later. Not in a bad sense of flipping them, but make a market, like a house or a stock.
Right. Right. Right.
And that's I definitely could see a huge market opportunity for them to say, "Hey, this is great for you. Here's someone you can trust, and if they're not the right resource, they will let you know."
Yeah. Yeah, my take on it is it's evolving because when I first kind of learned a little bit quite a bit more about family offices, when I was actually exposed to them quite a bit was back in 2006. And it was very big family offices with names that everyone would recognize. And that was what a family office was. And they kind of had their investment portfolio and then their hard assets. And then, they would look at some companies sometimes. Now there's really almost it's a substitute almost because a lot of it doesn't mean ultra wealth individuals or families. A lot of them are 5 to $10 million, maybe a little bit more now. And they're opening family offices for a lot of the tax advantage benefits of opening a family office. And when they have that windfall of money, even 50 million and down, they're taking pretty concentrated positions in companies where they are like the private equity firm or the VC company being the sole investor in this company to say, hey, yeah, we like this. And they do some measure of due diligence, not a lot, but I can't imagine that they have a lot of financial expertise like a firm like yours would have. Not even close. They might have gotten very good. In fact, one of the last family offices I spoke to, they sold out on just a service company, and they know that service. So that's the kind of company they want to invest in. So they know it from part of the business side, but not fully,
One of my favorite,
not
you
down into
talk
the finances.
and you talk about these smaller shops, and one of my favorite strategies right now in the PE world is roll-ups. And
Hmm.
you could get a lot of
Yeah.
smart people to say, here's the number of companies we need to roll up, and then a really great banker to do the diligence on them. Make sure there's no risks, blind spots, all that. And when you start working through that, a lot of private equity firms want to layer in debt. When you do that, that means you need an audit, which means you need an 805 memo, and you need CECL, and you need all these things. That's usually where I see there's a lot of um, kind of
That went like that for a lot of people right now. What is he talking about?
Yes, well, unfortunately, having worked through many of these roll-up strategies and different types of go-to-markets
Yeah.
is there's a lot of things
No.
and that's where, for us, and, a lot of folks could really help on these small office shops to say, "We know what you should look out for. As you're approaching this is how you get around that hurdle when you start planning."
Yeah, that's actually a pretty cool take that you just made because I'm thinking of, let's say, an HVAC company, because these home services companies have certainly been a big part of the roll up discussion. Big targets for PE where they're go get one, implement the systems. It works. Let's grab more of them. And how do we flip them to the next level? But if you are, let's say, the HVAC owner and you end up saying, "Hey, I want to actually acquire more." Uh, that could be a place for a company like yours to be able to come and actually give them the know-how to do that without having a PE company involved, right?
So we've done about 2 to 3 of those where engaged,
There we go.
roll up companies. And it's a very unique skill. And the reason I say that is you're not just doing the work. You have a ticking time clock with a culture that's going on. If you let someone run in their old environment for 3, 4, 5 months, they're going to assume they can do that in perpetuity. So what we usually kind of see is that you got to move fast. When you close that deal, you better start moving things, saying you're going to be an RERP and we need to move all your vendors on over because you got to stop that. And so knowing how to not only anticipate the tactical needs of we've closed this deal, where's the cash? How do we do this? How do we do that? But also, how do we make sure culturally it's a good land into our firm? So it's all interesting.
Yeah. Yeah, no, I could talk to you about that for a long time, man. That's pretty cool that you've
Maybe
already
for
been
another day.
working with
Yes.
those types of companies because yeah, yeah. Well, I just know as you're doing that, it's kinda like, what is like, if it was the HVAC company that wants to roll up a bunch of companies, they're thinking to exit somewhere on the back end, and having someone like you with the foresight to say, "Hey, this is what the PE company is gonna be looking for if they wanna even accept what you're offering," right?
And
How do we
part of
make you
that
att look
too,
attractive to that?
as we start talking about it is what is your valuation multiple? And then what are you buying down below? So are you buying these things for 1 times the revenue? And are you ended up being 2, 3 times the revenue? Or are you buying firms at 3, 4, 5 times the revenue because you like them? Because that's kind of a problem. You need to find stuff that makes sense because that's how private equity, that's how other buyers are going to think of your business. Investors, they're going to think of your business. They're going to look at it and say, you're
Yes.
buying these things for more expensive than your own valuation. So you're diluting your valuation. Why should I buy you? And that's where a good strategic hand helps you in all these things.
Yeah, no doubt. Let's kinda close up by talking a little bit about what you think about the future of finance for startups. Where do you see finance automation going?
I think automation is ripe for the future. Like, I'm a firm believer in it. So I try and automate everything I do. I would say, like, if I could, Chris, I drink margaritas, a lot. I would drink a lot of margaritas. I don't want to spend time classifying transactions. I want to go drink margaritas. So with that motivation
Yeah.
behind me, what I'm thinking through is how can I automate all these things away? And I mean, it's a funny little quib and all that. But in all
Yeah,
seriousness,
sure.
it's like how I think through this stuff is humans are great at putting their own perspective and opinions and thoughts behind this. But there's a lot of things that can simply be done in a tool. Now, I will say this is someone's got to manage and watch the tool. So when we talk about like, every once in a while, you got to step away from that margarita and look at this and say, I need to be a mechanic. I need the integrations to work. I need the rules to be fixed. I need to watch my books to make sure everything's flowing through properly. Because if it's not, then you need someone who knows what to look for and how to look for it in all this automation. You see this big push in AI and the wave in AI. And what I keep hearing time and time again is that at people who are low level and not super technical in building things, it's going to be tough. AI is going to cause disruption. Now, people who are know how to guide the prompts and know what they want their vision to be, those are the ones that are really going to thrive in that world. And I would rather train people myself so they know what I know rather than have this kind of robust ecosystem of consultants that can do this and can do that. I would rather have people that are really good and really smart and very motivated that I know that I pick, that I train, execute against what founders want. I don't want, what I want to be is I want us to be a highly, like, really good tailored firm for your business. It doesn't scale well, and I'm not trying to scale it well. I want to be able to always provide extra value to clients at just an amazing price, and that's what I want.
Just as a closing, like, if a founder is feeling overwhelmed right now, what's the first step they should take in your eyes?
If a founder is feeling overwhelmed, asking for help is not a weakness. Asking for help is always it's always a good thing. Whenever I've done that, it's usually helped relieve all the stress of everything. And when you ask for help, make sure to check with your trusted resources, your investors, your board, your friends, folks that know the pitfalls you're facing, because they'll tend to give you a real and honest opinion. That's would be my advice.
I love it. Ask for help. Yeah, I think A lot of times ego and pride gets in the way, and like a lot of things get bottled up, and people fail in things they shouldn't have because they had the help all around them, waiting and willing, right?
And it's hard too. Like I just had a conversation today with a founder who said she's trying to find someone to do a co-found she's trying to find a co-founder. She goes, "I don't even know what to think through." And we just simply had a conversation to say, like, they were interviewing someone, they wanted to have veto decisions on her ability as a CEO. And I said, "Is that really what you want? Like, is that someone who you want to build this thing with is already all before you've even signed, they're already fighting you on decisions contractually." Um, so
Yeah,
I would say know who you can trust, but it's okay to ask for your board, your investors, they want you to succeed as many times as they may knock you and ding you. Individually, they all want to watch you succeed. I mean, they have a vested stake in you for sure.
yeah, I love it. Tim, where can people learn more about Finity?
Yeah, feel free to reach out. Website is finitynow.com, when you want it is right now. So that's why we're finitynow.com. And
Love it.
you know, uh, there's plenty of ways to get a hold of us. You can contact me through my email. Um, yeah, we're always happy to have a conversation.
Awesome. Tim, thanks so much for joining today.
Yeah, thank you, Chris. I appreciated it. It was a great conversation.
It was. Thanks.